Uncle Sam taking a bite out of companies left and right. We have Intel deal, but today we're going to be focusing on MP Materials, the Trump administration's answer to China saying America can't buy rare earth materials. To discuss, we have on Daleep Singh, former Deputy National Security Advisor for International Economics, now with PGIN, Arnab Datta, currently at Employ America and IFP, as well as Peter Harrell. All right, to start off, why do like MP materials even need to happen in the first place?
Jordan, critical minerals markets, they're broken. And I'd say they're broken for three reasons. One is concentrated market power. China refines 70 to 90% of most of the minerals that we need to power clean energy, digital infrastructure, defense systems. And so they have enormous market power, not just over supply, but also pricing, standards, logistics. And no market can be resilient if one player dominates the entire market ecosystem. Second problem is price volatility. So prices for minerals like lithium or nickel or rare earths, they swing far more violently than oil and gas. And so if you're a producer, you're facing asymmetric risk. If you undersupply the market, you may lose a bit of profit. If you oversupply, you may go bust. So that asymmetry is what deters investment, that we need to expand supply when quantities are low and prices are high. So the market doesn't clear. And then the last problem is that we don't really have a market infrastructure for critical minerals. For oil, we have futures exchanges. We've got benchmark prices. We've got deep liquidity. For most critical minerals, we don't. Transactions are opaque. They're bilateral. They're heavily distorted by state intervention, especially China's. And so markets, they don't provide price discovery. And producers and consumers, they don't have hedging tools. And investors lose confidence in these markets and they walk away. So all in, we've got a problem of chronic underinvestment. We've got chronic gaps between supply and demand. And we've got chronic vulnerability to geopolitical shocks. Those are the problems.
Daleep, let's do a little more on the market infrastructure piece. What does this mean in practice? That it's not like WTI Brent or something.
Well, if you're a producer, you need to have a tool to manage price volatility. So if prices fall dramatically, you need the ability to continue generating revenue so you can stay liquid. And so you need futures markets, you need option markets that you can use to hedge against downside price risk. And right now, if you're a critical minerals producer for most of the minerals that matter for our economic security, you don't have that option. You also need to know where are prices in the market. You need price discovery. And, we really don't have genuine price discovery for many of these markets. China can decide just by virtue of its dominance in terms of supply, where it wants the price to settle. And if it wants that price to settle at a level that wipes out the competition, that's its choice. And that's not a market.
Daleep mentioned the market infrastructure problem, and this was really an intentional strategy by China, right? So they, in addition to, a very robust industrial policy that, provided a lot of subsidy to producers and refiners, they stepped into the market infrastructure problem that was really retreating in the West, particularly after the global financial crisis, when you saw a lot of liquidity leave Western markets, partly because of regulations that were passed during that time. China really seized the opportunity, and they built exchanges and benchmark contracts on Chinese exchanges so that they could control that market infrastructure and how these prices were constructed.
I might just add two pieces to that. So first is America's dependence on China in particular for rare earths is actually a relatively new problem. Historically, if you go back a number of decades, the U.S. actually produced, mined, refined, and processed and manufactured plenty of rare earths in the 1950s, 1960s, really through the 1980s and into the 1990s. It was in the 90s and 2000s, in the kind of era of peak globalization, where China really quite successfully expanded its rare earths refining in particular, that you saw the Chinese firms begin to outcompete American firms and a real decline in U.S. manufacturing related to this consolidation of Chinese control. So this isn't it's not that the U.S. never made rare earths. This really is a kind of problem of economics that emerged in the 90s and 2000s. And then second, we obviously saw just a couple of months ago the critical risk that the dependency on China for rare earths gives us, because as part of the trade war Trump blundered into with China back in April, China retaliated by threatening to and then actually cutting off its exports of rare earths to the U.S., which had the potential to really impact manufacturing here in the U.S. So it became much less of a kind of hypothetical long-term risk and much more of, oh, this could actually hurt the United States in the near term. Because of the way China acted in response to Trump's trade war in April.
And one thing, Jordan, just to add to that on the WTI comparison, right, is that if you think about how WTI is priced, it is a physically cleared contract. It is, you are purchasing a barrel that will be delivered at Cushing, Oklahoma. And the difference in kind of a lot of these, the thing that goes into that is pipeline transport and logistics, and like you have a whole infrastructure of traders and logistics and port managers, and all of that is going into the price of that physically delivered barrel at Cushing. And that's something that we just don't have in the context of a lot of these newer metals markets, right? And so it's very difficult to really ascertain how you should price a material when the only analog you have is a Chinese benchmark potentially that has very different constraints and very different tax regimes and very different cost inputs going into it and very different level of subsidy.
Peter, Daleep, you guys aren't dumb. You knew that this was an issue. People have been writing about this for a very long time now. What is the sort of activation energy required in the 21st century to do the sort of industrial policy necessary to really change the dynamics on an issue like rare earths? And why have you only seen small kind of like half-born efforts until spring, summer 2025?
So, Jordan, I appreciate the question. And as you said, this isn't a new problem. I mean, I think policymakers have been aware for more than a decade that there was a U.S. dependency on China for rare earths. Also, the Chinese had cut off their exports of rare earths to Japan back in, I want to say, 2011, or maybe it was 2012. So we'd actually seen the Chinese do this playbook once before on an allied country. So it's not a new problem. And it's not that there were no efforts to deal with this issue prior to the deal that the Defense Department announced in July. There were some efforts. So there'd been previous grants, including to MP, the company that got the deal in July, to try to restart manufacturing and mining and processing of rare earths in California, where there'd been a long time a U.S. mine. Actually, the mine had gotten reopened in 2017. There'd also been some grants to other companies and to universities to look at other ways of mining and processing rare earths, for example, to bring them out of mine tailings in West Virginia. And there'd been some money out there to try to sponsor government money out there to try to promote innovation to reduce dependencies on rare earths, maybe create some magnets and things that you need rare earths for, but not needing the rare earths. So there'd been some policy processes and some policy money put into trying to address this problem. But I think there were a couple of challenges with those prior efforts. First is just like scale of the effort. I mean, frankly, the way Washington works, until there is a very acute crisis, it can be hard to mobilize the scale of effort that is actually needed to solve it. So, these prior efforts were a lot smaller in dollar spend and in scale because the crisis seemed less acute. And I think that's just a political reality of the way Washington works, Jordan. And then second, this is as we can talk about, this is a very complex issue. I do think solving the issue requires several parts. I actually don't even think this new DOD deal with MP is going to be the whole solution. I think it's going to require several parts. So it is, in fact, a very complex issue. And then third, related to the mobilization, solving a problem like this is going to cost money. And you get into these big debates about who should pay for it. Should it be, U.S. taxpayers got to come up with the money? Should you make the private sector bear these costs? And so I think solving that, it adds to why it just takes time. But it's not that there was nothing. It's the way I would think of it is there was some foundation that this deal is now building on. Not that there was nothing that came before. But Daleep, would welcome you also defending our work together in the Biden administration.
Jordan, I appreciate you suggesting that we're not dumb. That's nice. We don't always get that. But, look, I think there have been piecemeal efforts to funnel public money towards private sector companies that could help produce minerals that we need. But what we haven't done is fix the market. And so, that's where Arnab and I started thinking about reimagining the Strategic Petroleum Reserve into a Strategic Resilience Reserve for 21st century vulnerabilities. Because, when prices crash and China's going to continue to flood the market, we have this recurring problem of producers going bankrupt, right? So can we think about a market mechanism, a strategic resilience reserve that could be a buyer of last resort or provide bridge financing to companies that are solvent but illiquid? That's what could allow producers to keep producing during downturns. That keeps production capacity alive. What can we do to solve the problem of investors not having any confidence in these markets? Well, if you don't have futures markets and you don't have hedging markets and refiners can't lock in predictable revenues, could a strategic resilience reserve step in with tools like selling a put option that allows you to make money when prices fall? Or could it provide a price floor or some type of demand guarantee? The point is, can you create enough certainty for private capital to keep flowing? And then what do you do about the concentration risk? Even with a deal like MP, there's no country that's going to mine its way to self-sufficiency when we're up against what China has. But we do have producers and miners in places like Canada, Australia, Finland. They're hesitating to expand production because they know China can tank prices tomorrow. And so an SRR, if we got that authorized, could it provide demand backstop, some offtake agreements? Could it intervene in the market so that producers in allied countries know they're not going to go bankrupt if Beijing floods the market? That's the kind of idea that we've started to come around over the course of time, and probably with some mistakes, to change the market itself, rather than a series of ad hoc transactions that don't really alter the economics.
So SRR, Strategic Resource Reserve, it's going to in a few moments. I would also like to say, in defense of the last 20 years of American policymaking, that, this was a latent threat, and the trajectory of U.S.-China relations such that this became an actual threat has manifested, relatively recently. And the fact that the Biden administration in particular was able to, quote unquote, get away with doing semiconductor export controls, with doing big tariffs on, basically banning Chinese electric vehicles, a handful of other tariffs, without triggering this sort of response, which, is impactful enough to really change the fate of important companies and potential sort of macroeconomic levers in the U.S. is, it's important to recognize this being a problem happens in the context of the U.S.-China diplomatic relationships. And without that kind of souring or getting escalated one way or another, then this is okay, we just get to use some subsidized magnets and the world moves on. Anything else on that, Peter? I don't know. How did you guys what was both of your thinking about not, trying to inch forward with more and more aggressive economic tools while sort of seeing things bubbling up in terms of new Chinese legislation, but not wanting them to actually hit back for the efforts you were making?
So maybe what I'd say when I think about how one can actually solve a problem like our dependency on China for rare earth elements, and then we can unpack what this deal will and will not do. I think as we were thinking about it, if you are going to solve the problem, you actually need to think about several different categories of policy tools that you need to mesh together to solve the problem. So we've had this history in American industrial policy in the past, going back some decades, where we have focused almost exclusively on what you might think of as supply side industrial policy. So, we've given grants to companies to build a factory or to build a mine to do something. And in some cases, that can be sufficient because the problem that we need to solve is one of basically startup costs. It costs more to get something off the ground in the United States, and you can provide just a kind of CapEx incentive to help get it off the ground. But when you look at China's dominance of rare earths, where they not only have already spent a lot of CapEx, their operating expenses are lower than in the United States, and they control the market infrastructure. If you want to break China's control here, you can't solve it simply with like our own CapEx. You also, as Daleep says, need to think about the market infrastructure, and you also need to think about what the demand side of this is. Like if the U.S. operating costs for producing rare earths are going to be higher than they are in China, you got to find some demand for that higher cost U.S. product, or else the U.S. companies are just going to keep buying Chinese, right? Because the Chinese stuff is going to be cheaper. And so you need to create a market infrastructure that's going to ensure stable demand for the U.S. made product, and layering these things together, these kind of different sets of policy tools to address the different parts of the chain. It's just not something the U.S. government, has done in a long time. And there's a lot of kind of, you gotta get your reps in and sort of, spend some time in the gym before you can actually do it.
And look, I think Peter and I used to sit in the part of the White House that was straddling economics and national security. And I think for most of us, very early on in the term, we understood, especially as Russia's forces were mounting on Ukraine's border, we're going to be in this incredibly contested geopolitical environment for the rest of our lives. And China and Russia have now made it very clear and revealed they're going to challenge the U.S.-led order everywhere. But because, today's great powers are nuclear powers, our expectation became that this competition is going to play out mostly in the theater of economics and energy and technology. So then the question was, if we're going to prevail, how can we harness the financial firepower of the world's most dynamic financial system to advance strategic objectives? Do we have the right tools? Do we have the right institutions to overcome this short-term profit motive that drives most of what's going on Wall Street? And the answer is no. So then I think as time went on and we started to have a bit of time to breathe, quite frankly, can we start to think about new ideas? And that's where I mentioned the Strategic Resilience Reserve came up. We also started to think about whether the U.S. should have a sovereign wealth fund. And these are all ideas that are trying to solve the same problem, which is that the private sector systematically underinvests in exactly the kind of projects that matter most for our economic security and for our national security.
All right. I hear Daleep chomping at the bit to talk big systemic solutions, but we should get through the news first. Arnab, all right. So what does this MP materials do? What is interesting and exciting about it? And why is it not a systemic solution that Daleep so craves to manifest?
Yeah. So look, I think you got to take it. One thing that this deal does is it does treat this problem holistically, right? So Peter mentioned that you need a mix of supply and demand side tools, and the administration does deserve credit for using the DPA, the Defense Production Act, in a robust way. They are applying a toolkit that includes loans, equity investments, price floors, a guaranteed contract for offtake for the finished product. And so that's like something that, frankly, that's just a recognition. Ultimately, if we're going to deal with this problem over the next, 1 year, 5 year, 10-year, decades, we need a robust toolkit, and we need a varied toolkit, and we need a mechanism by which we can address these very challenges.
Yeah. So Arnab, just briefly, like, who actually did this? This is very like sophisticated, impressive work. I mean, and yeah, it's a lot of puzzle pieces which haven't been put together in a very long time.
Yeah, so it was done through the Defense Department. It actually pairs a number of different authorities. So I would say the most kind of creative, atypical interventions were through the Defense Production Act, which is, this is Title III of the Defense Production Act. It has a very wide authority attached to it. So, Peter did a recent piece in Lawfare examining this, but it basically allows you to engage in a number of different transaction types to achieve the goal of building our defense industrial base. There's also some capital from the Office of Strategic Capital. That's where the loan is coming from. We also, one thing to keep in mind is that we don't know. Some of these appropriations are not spoken for. So over time, you could imagine funding coming from different parts of DoD, from the National Defense Stockpile. I think they're kind of going into this with the commitment and a very clear interest and effort in continuing with this deal. But there are some risks. And there's also some, structural challenges with this deal that I think, I'd be happy to go into as well.
All right, so Peter, give us the flip side. What doesn't this accomplish and solve?
Well, let's first just walk through kind of 101. What is this deal? Because there was, some news last month when it came out. I think a lot of the news focused on the fact the Defense Department, as a piece of this deal, was taking equity in MP Materials, which now looks like sort of a precursor for the Trump administration going out and taking equity in Intel and maybe a whole bunch of defense companies and everything else. So I think that was the piece of this that kind of attracted, in some ways, the news. But the deal's actually a fairly complicated deal that has a couple of different parts. So part one of the deal is the government essentially gave MP Materials, this mining company, some loans and then some cash as part of the equity stake to expand its mine in California, not actually that far from Las Vegas. Las Vegas is kind of the nearest big airport to this mine, but it's in California. So to actually expand production at the mine, and then relatedly to expand and build a new facility to actually take some of the rare earths being produced in this mine and to manufacture them into magnets. Because what we actually need is not raw rare earths. What you actually need here are magnets that go into motors and turbines and all kinds of other things. And there's almost no magnet manufacturing in the U.S. And in fact, previously this mine had been producing rare earth kind of ore and then selling it to China in order for it to be made into magnets over there. So part of this is like a capital injection to MP to expand the mine and to build some magnet processing, expand some magnet manufacturing capability here in the United States. And they're doing that with both a debt and equity take. And then there's a piece of this, because we mentioned the need to show demand here. So the other thing, another part of this deal is the Defense Department, set a price floor for kind of the raw rare earths, where the Defense Department has guaranteed that when MP is mining and kind of doing initial processing for the raw rare earths, it now has a guaranteed minimum price, which, by the way, is about twice what the current Chinese market price is. So that's how you guarantee that it's economical for MP to make this stuff over the next 10 years, because DoD sort of said, hey, even if the market price is 54, which is about what I think it is today, we're going to pay you $110 per kilogram. We'll pay you the difference between 54 and $110 per kilogram. So you have this price floor for the kind of minimally processed rare earths coming off. And then DoD on the magnet side also said, we'll buy all of your magnets. You can produce these magnets for the next 10 years and we'll buy all of them. And then there's some deals there's actually some interesting pieces of if DOD and MP jointly agree that some of the magnets can be sold, not to DOD, there's some sort of profit sharing and that kind of thing in there. But it's actually a pretty complicated deal with interrelated parts, which very clearly does ensure the viable business for the next decade of MP. MP gets capital injection. MP gets a guaranteed price floor for its rare earths. Concentrates are called, sort of minimally processed rare earths. And then MP has a guaranteed buyer for its magnets. So MP's taken care of for the next decade and will be able to scale up production of both the kind of minimally processed rare earths and probably of magnets. But that doesn't mean we have a market here. What we have is a market for MP. And that's where I think there's some interesting questions about this deal. And are we really right to bet all in on MP as sort of a national champion? Or actually should we be thinking more systemically about the markets, a little bit less more about how do we guarantee the success of this particular firm? But Arnab, I know you have a lot of thoughts on that piece of it.
Yeah.
So, yeah, I mean, so how should I refer to this article you got, the draft you guys wrote? Like, is it coming out soon, or what's it?
I think I would just call it forthcoming article. We're hoping to get it into Alphaville there, but they're kind of working it up the chain there.
Okay,
so,
okay.
we're not fully signed out.
So,
yeah.
okay. So in this piece here, and Arnav, you point out that, or my takeaway is this is like China's industrial policy circa like Mao era, like, version 2.0, we're off gut strings onto synthetic, like Alcaraz style forehand. I mean, you're picking one winner. And by the way, this company is like probably not the best managed company in the world, as opposed to the way that China does it, where you have, you have lots of firms fight it out to be the top dog. And then once you sort of whittle it down to not one, but like 5 or 7, then you start really turning on the jets and pouring on the money when it comes to trying to secure your position in the global marketplace. As Daleep alluded to, this is also a concern with Intel, though for what it's worth, I do think that, manufacturing at the leading edge is probably, I don't know how many entrants that can necessarily support, as opposed to like, just like building some mines and making some batteries. But there does seem to be some tricky incentives and a lot of risk that their head of mining doesn't go to a Coldplay concert with their head of HR or something. Daleep, where are you on this as an approach?
It makes me think of Intel a lot, and I realize that we're talking about very different markets. But I have the same sort of take on it, which is like, let's actually pivot for a moment to Intel. There definitely needs to be government intervention in both of these markets. With leading edge semis, of course, we don't produce any of them. Intel's the only U.S. firm capable of making them, but it has no customers. And without customers, Intel can't scale. Its unit cost efficiency remains low, and its competitiveness lags. Market forces aren't going to solve that problem, nor will it solve the problem for MP. But what gets interesting is instrument choice. And what I worry about is kind of ad hoc improvisation about what tools of industrial policy to use for particular sectors with a different context and a different kind of problem to solve. And what I come back to is, again, the systematic stuff, Jordan. So we do need a playbook, a governance structure, a doctrine, if you like, for industrial policy. Start with the strategic objective. What problem are we trying to solve, whether it's MP or Intel or any other company? What is the market failure? Is it a shortfall of demand? Is it a capital constraint? Is it a cost differential? Is there a coordination problem? Is there some national security externality? Because then the third step is, okay, pick the policy instrument that remedies the failure. Don't just default to equity injections or subsidies if the problem is demand, for example. And then can you actually intervene? This goes to Peter's kind of laydown on MP. Does the intervention actually sustain competition? And does it avoid a single point of failure? Yes or no? I would try to avoid, substituting a foreign monopoly for a domestic point of failure. And then can you actually tie the support to milestones, objective milestones, so that you can claw back the support you're giving from taxpayers if they underperform? And can you sunset the support to avoid the kind of permanent dependence? And then the last thing is, how are you actually measuring the strategic return? What is the metric for success with this deal? It can't just be the financial gain. So how are we going to measure the benefit in terms of resilience, security, technological edge? That's what's missing for me. And maybe it's out there somewhere. I just haven't heard it.
Add to that a couple of things, right? I mean, I think, Peter and I wrote basically this. This is a national champion that's crowned without contest. And we do have a pretty robust, vigorous competitive process folding out right now in the magnets space. There are other companies. MP Materials has the Mountain Pass mine. It has never produced a commercial magnet. It has not sold a rare earth magnet at commercial scale. When you think about the challenges that go into selling commercial magnets, automotive is a major purchaser of these magnets. You need to get your production facility warranted. That's a really, really long process. There's no sense right now. We don't know. They could get warranted for automotive. They might not. It's a very challenging process. And we do have competitors that are innovating. There's a company, Niron Magnetics, that's based out of Minnesota. They've produced a rare earthless magnet. And this is kind of the best of America, in my opinion, right? You're innovating yourself out of this vulnerability. I don't know if Niron can scale at this point to the commercial scale that we need, but I also don't know that of MP Materials. And I think when you start to get into some of these policy questions about is this intervention in this single company the right one, it raises a lot of secondary thorny issues. This is really a bet on vertical integration, right? For rare earth magnets, you have that's what they're trying to build here with MP Materials. That might be a good thing. A lot of the Chinese champions are vertically integrated. But there's also a world where vertical integration on its own creates its own vulnerabilities. We see this a lot in the metals space where, when we need to plus up production because of some challenge, it's not the vertically integrated producers that are responding quickly to price swings. It's the marginal producers, the independent producers. This is something very common in metals markets. It's something very common in the oil sector as well. And so, these are really important policy questions. And I think my biggest concern, globally with this deal is I don't know what that reasoning is. And it's possible there are very well thought through reasons, but these are things that, need to happen with some kind of a process that has, technocratic, democratic legitimacy to it. And so I think that's why, Daleep talking about the systemic solution is really important, because we do need to make sure that these decisions are made in that context. I am not opposed to equity investments of all kinds. I think it's a really important tool for the government to have. It lets you push the risk frontier for your investments if you're a program. It lets you participate in the upside. But that needs to be done in a very thoughtful way. It's a very powerful tool. And we need to think about, are we actually inculcating the things that make the American system dynamic, like competition, innovation, technological innovation?
Do you guys know, can I ask Jordan, what is the exit strategy from the MP deal? I mean, is it tied to production capacity or profits? I mean, how is the government going to sell down its public stake, if at all?
It's not, that part's not, I mean, the SEC filings talk about, the SEC filings talk about the government taking the stake. The government has also, in addition, Daleep, I should say, in addition to the price floor, the guaranteed offtake agreement for the magnets, in addition to all of that, the government has kind of in a belt and suspenders approach also guaranteed MP an annual profit of $140 million a year. which the government will pay if it's is a cash payment if it's not generated from the operations of the company. And so presumably the government is intending to hold its equity for at least the 10-year duration of the other elements of this deal. But actually, there's no specific language in the SEC filings about the government's exit plan. It's just about the equity and then the duration of these other parts of the deal, which is a decade.
It's structured as a 10-year deal, and so I think ultimately the expectation is that the price floor and the offtake agreement will end at that point. But how do you? There's no kind of protections against the dependence, right? Like, how do we stop this from just becoming something that's permanently dependent on this subsidy? It's not clear. And it also, this particular deal doubles down on the Chinese market infrastructure. The benchmark that they are using is the Asian metals benchmark. And so, that brings in the risk of manipulability too. Like, China can basically bleed DOD for hundreds of millions more just by flooding the market. How long is Congress expected to continue appropriations for that? These are not paid for, right? The one thing that was very clear in the 8K is that they don't have appropriations for all of this. And so, like, how long can we expect Congress to just keep paying, I think, is a very reasonable question as well.
I want to have the strategic question. I think maybe we'll start with rare earths and broaden out to your other things that you would want to sic a strategic resource reserve.
Jordan, I'm just going to correct you because we do have a bill coming out for this. Yeah. It's a strategic resilience reserve.
Excuse me. Great. So let's have the strategic conversation that Daleep alluded to. What are reasonable, what are the right goals over, a 3, 5, 10-year horizon when it comes to rare earths in particular, and then more broadly, the types of things that you would want the strategic resource reserve to touch. Did I get it right?
Strategic resilience reserve.
Sorry.
No worries.
You would want the strategic resilience reserve to start to play.
Yeah, so I think there's a couple of key objectives that we're trying to build here. One is, can we build a governance structure that is independent, technocratic, and driven by the realities in the markets that it's playing in, and not by political exigencies or other kind of factors. So that's like one thing we want to do with this proposal. Second, can we build that robust toolkit that we talked about earlier for different markets, right? So rare earths, we've talked about a lot, have particular unique needs. They're smaller than some of the bigger metals markets, and so we don't necessarily we can't be sure that you need a futures market for every rare earth that is on the market, but that's like a major goal as well. And then third, I would say the explicit purpose of what we're trying to do here is build that competitive market. So are you supporting the build out of a market infrastructure that is tied to actual market dynamics that US and allied producers face? So are we doing lending with intermediaries that can engage in more trading activity because they've got the leverage that left the market in the 2010s, as I described? That's a really important piece of it, because over 5 to 10 years, if we can have a more stable market infrastructure for US and allied producers that reflects the costs they face, the logistical challenges they face, ultimately, you'll have a better, stable foundation in place for those producers to compete.
So Beyond solving the sort of market plumbing for things that would fall into the strategic resilience bucket. What is the big, bold version of the systemic and thoughtful way to do the sorts of things that we've seen over the past few months with MP and Intel, and we've seen over the past few years with the CHIPS Act and the IRA?
The maximalist version is a sovereign wealth fund, Jordan. If you believe that the private sector systematically underinvests in projects that we need most for economic security and national security, then we're not going to invest as a country at pace and scale to build fusion plants or dozens of semiconductor fabs or next generation lithography or 6G telephony. You pick your technology, advanced geothermal. We're also not going to invest. So those are all areas where we want to enhance a competitive advantage. We're also not going to invest enough in old economy sectors where we need to blunt a competitive disadvantage. So think about shipbuilding or lagging edge chips or mining. And what all of these projects share in common is they require a lot of upfront capital, and they require a decade plus of patience to generate a commercially attractive return. And you need a huge tolerance for risk and uncertainty. The private sector, venture investors in particular, but also corporate America, they're not likely to touch these in the size that we need them to, because they've got plenty of other opportunities to make faster, higher, less risky returns. And so that's why we have this valley of death, right, between breakthrough research and commercial scale. So I think we do need the maximalist way to solve this problem is to create a flagship investment vehicle that gives the United States patient, flexible capital that can step in where markets won't, and that can crowd in private investment and back projects with genuine strategic value. That's the case for a sovereign wealth fund. It's not about picking winners, though. It's really about picking supply chains and technologies where our national security and our economic resilience are at stake. And it's really premised on the idea that left to itself, America's financial system is not designed to maximally align with our national interests. So we need to intervene.
I remember first reading you and Arnab's piece on this a few years ago and thinking, fat chance. But now, it's like Trump is into it. I wonder if it wasn't called the golden share, if he would have been as excited in this as a concept. But you do enough one-off ones, and then you also learn that there are mistakes in the one-off ones and that you aren't necessarily getting a systemic solution. And it can kind of go both ways. Either you give up on the project entirely, or given that the sort of broader strategic purpose for these things keeps rearing its ugly head, you start to think in a larger and more systematic way attacking these problems. So yeah, Daleep, let's go a level down. How are we funding this? What's our governance structure?
Okay.
How's the democratic involvement? Yeah, give us a few more minutes on this.
Before we go, I'll come to that in a second, but I think whether you're focusing on the MP deal or the 10% stake in Intel or the 15% revenue share from NVIDIA or the golden share in Nippon, again, the point is we have a choice. Either we can improvise and experiment, or we can develop a framework. Because, I think the problem with improvisation is that if we just reach for different levers, like an equity stake here, a profit share there, a golden share somewhere else, if we don't have an overarching framework for why we're using these tools and when and how and to what extent, I really worry that this has the makings of a political piggy bank and a national embarrassment. And look, to some degree, I understand this. Some degree of experimentation is going to be needed. We haven't done industrial policy in 40 years and the muscles have atrophied. So I get it. Let's take small steps and learn from those steps and then recalibrate. But I don't want to I'm not in favor of ad hoc capitalism with American characteristics, because that's inevitably going to end up picking favorites and distorting incentives. So look, you're asking the right question. How do you govern a sovereign wealth fund or a strategic resilience reserve the right way? How do you fund it? Look, on the sovereign wealth fund idea, my thinking is we're asset rich as a country. The federal government owns about 30% of the land. We have extensive energy and mineral rights. We own the electromagnetic spectrum. We have infrastructure assets all over the country. We've got 8,000 tons of gold that's valued at 1934 prices. We've got $200 billion of basically money market assets that are sitting idle. So the question is, are we maximizing the strategic bang for the buck on those assets? I would say no. So that's one potential source of funding. You could also just create new revenue streams to fund the vehicle. If you think that the United States has too much Wall Street and not enough Main Street, that we financialize the economy into a series of boom-bust asset cycles, then let's raise revenues from financial activities that serve no strategic purpose. I would say high-frequency trading, for example, and fund vehicles that are explicitly designed to advance our national interests. But look, my strongest preference would be the most...
As long as we stay away from fixing.
Yeah, exactly. That's untouchable. Of course. But look, I mean, the most appealing approach is the most straightforward one is ask Congress. Be straight up about it. Ask Congress to seed the fund, authorize its existence as an independent, federally chartered corporation. This is too important to leave entirely to the executive branch, and have Congress set a clear mandate in terms of the objectives, the metrics for success, the oversight, the democratic accountability, which Arnab was pointing at earlier. Look, it's a shame we didn't do this 10 years ago when our cost of capital was near zero. That would have made this effort far more affordable. But if this is about our long-term national competitiveness, we don't need to try to time the market.
Yeah, if I could just add a couple of things to that, because I think one model that obviously at Employ America we think about a lot is the Federal Reserve, right? The Federal Reserve has an independent board, still, knock on wood, and to continue hopefully. But that's really a structure that is well insulated from political day-to-day activities. It is not a 5-4 majority in power, minority structure. It has staggered terms, and that lends itself to, in my opinion, a depoliticization that's quite helpful, and it's given it's served us quite well over time. And then in terms of the congressional point that Daleep made, which I think is really important, we have had a version of this. We've worked with Senator Chris Coons's office for since 2020 basically on his proposal to establish an industrial finance corporation. This is modeled off of the Reconstruction Finance Corporation that we had in the 30s, 40s, and 50s. And we had, then Senator Vance on as a co-sponsor. So the political viability of something like that, I don't think is small. And the way we structured that was we appropriated capital to it basically as a backstop against the borrowing that the corporation could do itself. So this corporation could go out and raise capital raise bond capital, and then just deploy that capital towards these investments that Daleep mentioned. And one value add about that is, you don't need to compete with the private sector on the rate of return, but you can generate a rate of return. And so ultimately, that type of a structure could pay for itself. There's a lot of technical accounting rules related to how you would structure that, particularly the Federal Credit Reform Act would come into play. But that is a structure that I think could be viable over time. And we have the money to do it. And ultimately, because a lot of these investments would be productive, over 5, 10, 20 years, I think it would pay for itself.
All right. So before we close, I can't let you guys leave without a few more intel takes.
Yeah, one thing I would just say is I think we need to. I think I've seen two separate conversations happening. One is on the legality of this, and another on the policy justification. And I would point to Peter did an excellent piece in Lawfare that came out a couple of days ago. This is very possibly legal in a very technical sense, but really does probably violate the spirit of the CHIPS Act in that the CHIPS Act is intended to incentivize manufacturing investments, and they are giving this money to Intel, but relinquishing them of most of those requirements. Earlier we talked about milestones that companies should have to meet. Intel had a bunch of milestones attached to this money. They couldn't get it all until they reached those milestones. They now have this capital, but they don't have to meet those milestones. I think that's like a really, really big problem. And then, separate from the legality, on the policy proposal here, it's just like, why was this I would actually maybe just put this to Peter and Daleep if you want to chime in. Why was this the best thing for Intel? It's not clear. As Daleep mentioned earlier, they need customers. An equity investment is not going to help them in that sense. Like this, for all I know, the share price could go down and our investment could go down because they can't find customers. So I think it's a really, really big problem that we're not approaching this in how do we make Intel more competitive. We seem to be approaching it in this ad hoc, like how can we get the best, for our dollar in the form of an equity deal.
Yeah, that's my main concern is the right tools here. I agree with the intervention, but the right tools have to come from the demand side. So procurement guarantees, offtake agreements, sourcing mandates, all of those ideas make a lot of sense to me. But it's not clear how the equity injections fill the demand gap. And I also look, when you make upfront equity investments, you are foregoing optionality. I would have liked to see warrants or options that are tied to success. And, in general, I think policy support should be conditional. Conditional on whether you're reducing unit costs or diversifying customers or hitting your production capacity targets. And I do like the idea of clawbacks. So the government has lost a lot of optionality with an upfront common equity injection. Now, maybe there's a lot in the fine print that we don't understand, but that's what I found lacking.
I'd just echo what Daleep and Arnab said. I mean, the specifics of this deal are troubling. The idea of policy support, financial support to have onshoring of U.S. semiconductors clearly needed, clearly broad bipartisan support. The idea that we shouldn't just be dependent on TSMC, the Taiwanese semiconductor firm, for leading edge manufacturing, I think also has bipartisan and sensible policy support, right? You actually want to have some competition and some optionality at the leading edge of semiconductor manufacturing. But what this deal actually did was take a grant in which Intel was getting $11 billion in exchange for Intel investing, I don't remember the number, call it $80 billion in fabs over the next decade. And Intel was going to get the $11 billion in tranches as it built the fabs. And if it failed to build the fabs, there was going to be clawback. What this deal actually is now Intel is getting about $9 billion of the dollars just in exchange for the stock. Plus they do have to complete building certain DoD specialty lines. But basically most of the obligations to actually build fabs went poof, and they got the cash in exchange for stock. So I kind of get why Intel might have done it. They get cash that's largely unrestricted. Yeah, they dilute their existing shareholders, but they probably decided the cash is worth it for us to, do whatever we want with it. Reasonable call from Intel.
One quick thing Daleep's point made me think of too on warrants, which is, the thing here is if you they're using, in all likelihood, something called Other Transactions Authority to legally justify the use of this deal. Now, Other Transactions Authority is like an incredible gift to the Commerce Department to be able to design, very diverse mechanisms for policy here. And, in my opinion, kind of wasting it on this equity investment that has very little attached to it is a real mistake. Like they could really put some effort into something creative that did go to the root of the problem about customers. And they're really squandering it, in my opinion.
I think it all makes sense under a normal president living in the year of our Lord 2025. the way Intel survives is it gets customers. And the way it gets customers is Trump terrifies CEOs. And if 10% of the company is what Trump can do to terrify CEOs, then all right, we'll see. At the end of the day, it's not the government that's going to be able to sort of like give like I think the execution risk from when we were talking earlier about MP materials, right? It's like it's really not rocket science. Like you could have more of a beauty pageant with 5 different companies all trying to like mine different places and have something. There's one horse in this race, and you at a certain point just have to hope that they can execute as long as the demand's there. And my sense and hope is that I think a golden share owning 10%, like Trump will care and be more invested and put more of his cycles and I don't know, wrath into rounding up a handful of people who are gonna spend the time to deal with Intel and really help them get back on track. And regardless of whether it was warrants or a grant or equity, like it may change the sort of return profile of what like the U.S. taxpayer is seeing, but whether or not Intel is able to catch back up to TSMC is more going to be a function of execution and a president really turning the screws on U.S. fabless companies to play ball with Intel. And the fact that Trump is caring about this and is focused on this, I would not have necessarily priced in completely from the get-go. I mean, he was literally talking about having to fire Louboutin, like probably the only man who could, the best, I think, the person who I trust more than anyone else on the planet to like actually execute this right, who doesn't work at TSMC currently. So I don't know. I'm a little more bullish on this than you guys are.
Can I offer one pushback on that, Jordan? So one thing I would say is like, yes, there is a tremendous like focusing mechanism. Companies will, you saw this with MP where just a few days after the announcement, Apple signed a big deal with, a $500 million deal with them. The thing I guess I would say is like, at some point, the market has to trust that Trump's commitment to this company will continue. And, President Trump is not going to be president forever. And like Intel is not going to be operating only on a 4-year timeline. And so like at some point, Intel is going to require commitments from other companies. And, at some point they might just turn and say like, look, this guy's not going to be president anymore. We've got someone else to please here. And so, certainly like that's, I take your bullish case, but Intel can't survive only on that. They need an outside market, and they need, potentially capital from external sources down the line. And, at some point we're going to be in a post-Trump world. And I don't think that's, it could look very different for Intel.
Something I have sort of observed over the course of reading lots and lots of Washington policy papers is people tend to imagine the bureaucracies they want to run one day. So Daleep, I'm very excited for you to be America's first sovereign wealth fund runner. You have my vote, 2035. I'll be there at the inauguration of it. We'll find you a nice building. This has been a lot of fun. Thank you all so much for being a part of ChinaTalk. Do we have a song about minerals or sovereign wealth funds?